Our customers are usually going to be somebody who's been at this business for decades and maybe intergenerationally. So a multi-generation family, a long standing fund. And we're very selective about who we do business with. That's part of why we think we'll come through this in great shape. If customers who were with us in 2008 and 9 and performed well during that period of time, then those are relationships we've looked to build over the last 14 years or so, and have been again very disciplined on what we're looking for. So in addition to that, there's global cash flow, loan to value, guarantor support, things like that.
Hey, Steve, as other banks are coming to terms with their losses, would you be buying some of those loans from peers?
No, we're not a bank that buys paper from other banks or other sources. We're a customer-oriented institution. So if one of our customers had a loan at another bank and that bank was unwilling to go forward with them for any reason or ask them to refinance, that we would expect they'd come to us, and we'd certainly look at that, and if possible, we'd make that loan. We will support our customers.
What are your customers telling you these days? Are they taking down capital? Are they sitting tight? What are you seeing from both your retail and your corporate customers?
Well, now moving outside of commercial real estate, generally our commercial customers had an okay to good year in 23. Generally, there's some exceptions. And this year is starting to shape up better with more certainty and more confidence. Some of that is induced by the Fed effectively capping rates, or what looks like to be capping rates, and reducing rates. So that's a better environment versus an uncertain level of increasing interest rates. And additionally, there's been so much benefit out of the various stimulus packages that have come through in the data in the fourth quarter and already this year, that there's just more optimism that's generally in place. The consumer is doing well on the whole.
So is this an economy then that you think needs rate cuts, or is this an economy that needs normalization? What's your lens telling you?
I think the forward market reset that just occurred this week, going from 6 cuts to 3 or 4, is now in line with what we think might happen. I don't believe the Fed has to cut rates. I think just the fact that the outlook is not for increasing rates provides a level of certainty and confidence. I do believe, as inflation continues to adjust downward, that there will be rate cuts later in the year, whether it's 2, 3, or 4, anybody's guess. But I think the market's now much more calibrated tightly to what's a higher probability outcome.
Hey, Stephen, we had some of the weakness in some of the regional banks early last year, and then this year with New York Community Bank. What I think that brought to light for a lot of people is, boy, there are a lot of regional banks around the United States, some 4,000 of them. And I guess that just begs the question, is that too many? So as you think about the regional banking space, do you think it's ripe for consolidation? Do you think it needs consolidation? And if so, how do you guys view that at Huntington Bank?
Well, typically when we hear the term regional banks, it's usually banks 100 billion up to the G-SIFI levels. And then there's the mid-size, and then there are the community banks. The 4,000 banks you referenced would be several thousand community banks, 3,000 plus community banks. And by that, I mean they service a defined geographic area, typically not multi-state. Then you have sort of the mid-size that could be multi-state, and then 100 billion or more, you're going to be in multiple states. And so, NYCB, unfortunately, has a real estate concentration, a very high concentration. I think it's about 58% of their total loan portfolio in commercial real estate. It's one of the highest levels in the country. There's a softness in New York, and they're concentrated in New York. So very unique characteristics. I think what we saw from CBRE yesterday, saying they believe office valuations have generally bottomed out, it's a very encouraging sign.
But to that point, another part of what happened to New York Community Bank was that they got into a different regulatory tier, and they had to put more money away because of the assets they bought from Signature. What do you think? Has that happened to you? Does that sort of change how you view growth in the company?
Not at all. We're very much front-footed. We grew loans last year and deposits, core deposits, and we expect to do that this year. We're investing in the businesses. We see this as a moment where this uncertainty actually can be an advantage. We've got very strong liquidity, core deposits, capital, earnings. Our credit's been outstanding, and so we're investing. We're expanding. We've opened up in the Carolinas in the last quarter. We've added specialty banking business lines. There are a series of other actions that we've taken that will create more and more revenue for us. So we're in a growth dynamic.